Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, so here we are again, ready to synthesize the sources and give us all some shortcuts to being well-informed. And the environment. Right now, October 2nd, 2025. It's a real head-scratcher, isn't it? We've got this wild tech euphoria, AI pushing everything to record highs.
Absolutely gravity-defying stuff.
But then clashing right against it, you have serious macro risks. Political gridlock in the U.S., a government shutdown messing with data releases, central banks keeping everyone guessing.
Yeah, the Fed, the BOJ, ECB, lots of uncertainty there.
So our mission today, let's cut through that noise. We need to figure out what's really driving things. Is it the AI frenzy, the shutdown chaos, central bank moves affecting, say, the dollar yen or euro dollar? Okay, let's unpack this.
Well, the first thing that just jumps out is how the market seems almost immune to bad news right now. You mentioned the macro headaches.
Yeah.
But global stocks, the S&P 500, NASDAQ, even the European STEO XX 600 are hitting or are very near new record highs. It's quite something.
It really is. It feels like total tunnel vision, doesn't it? Just focused on that one big story.
It does. And based on the prepared resources, yeah, it seems this huge rally is almost entirely down to the AI trade. That and just sheer FOMO, fear of missing out, driving funds, retail investors, everyone wanting a piece.
Right. The FOMO is palpable.
And the signal, the thing that really cemented this frenzy actually came from the private market, OpenAI.
Yes.
They just did a share sale, and the valuation, a staggering $500 billion.
Wow.
That makes them the world's most valuable startup, bigger than SpaceX now.
$500 billion. For a company, what, less than 10 years old?
Yeah.
It's almost hard to grasp. Does that scream confidence, though, or is it maybe, a classic bubble sign?
That's the million-dollar question, isn't it? Or I guess the $500 billion question now. But the details around the sale actually suggest confidence, for now at least.
Oh, how so?
The sources mention that employees, current and former, they sold about $6.6 billion worth of stock.
Okay.
But apparently $10 million was available. They didn't sell it all.
Interesting. So they held back.
Exactly. That undersubscription, it suggests the insiders, the people closest to the tech, think it's worth holding on to. They believe the future value is going to be much higher. Seems like they're betting on massive growth ahead.
Huh. That employee conviction, you have to admit, that's pretty persuasive. So if the private side is signaling that kind of potential, how's that ripple through to the public companies, the ones building the AI infrastructure, the plumbing?
Oh, the impact there is huge. You can really see it in the semiconductor sector. That private valuation just fuels optimism about the total addressable market for everyone involved in AI.
Makes sense.
Just in recent trading, the combined market cap of the key semiconductor indices, like the Philly Semiconductor Index, the SOX, it jumped by over $200 billion.
Wow, $200 billion.
Yeah. And one analyst, Hebe Chen, she put it quite well, said the tech momentum shows no signs of waning, as if gravity doesn't exist.
Haha. Yeah, feels like that sometimes.
And that enthusiasm, it's just, it's overwhelming. The caution, concerns about a bubble, pretty much ignored. Everyone's just riding the wave.
Okay, here's where it gets really interesting. Because we have to pivot from that, AI euphoria to the things trying to pull the market back down. Central banks, policy.
A macro reality check.
Exactly. U.S. rate cut expectations seem to be firming up. That must be acting as a kind of counterweight, right?
Absolutely. The whole currency picture, that chess match, is really dominated by bets on U.S. rate cuts right now. And those bets got a big boost from that ADP private payrolls report.
Which was weaker than expected.
Yeah, unexpectedly weak. It really reinforced those worries about the labor market slowing down. Something like 70% of industries in that report showed negative hiring trends.
Oof. And that weakness translates directly into market pricing, I assume.
Instantly. You look at the swaps market, it's now pricing in roughly 1.9 more U.S. rate cuts before year end.
Almost 2 full cuts still expected this year.
And this weakening data, that's the main thing, pushing the dollar softer and keeping the 10-year Treasury yield hovering just above 4%, around 4.10% currently.
Okay, hold on. So the Fed's leaning towards cuts because of weak U.S. data. But across the Pacific, the Bank of Japan is actually talking about hiking rates.
Precisely.
That policy divergence, that must be putting some serious structural pressure on the dollar-yen pair. USD/JPY.
It's the defining story for USD/JPY right now, absolutely. We heard from BOJ Deputy Governor Uchida. He basically confirmed they're moving cautiously, yes, but moving towards normalization.
What did he say exactly?
He said if their economic and price forecasts hold up, and remember the recent Hankin survey was pretty positive, showing good business sentiment in Japan, then yeah, they'll adjust policy rates upwards.
Hike.
Hike.
And the market reaction.
Well, after those comments, the yen strengthened quite a bit, briefly hit 146.90 against the dollar. It's settled back a little, maybe around 147.0, 147.20-ish now. But crucially, the market expectation for a BOJ rate hike in October still really high, about 63% probability priced in.
So the market really believes it's coming soon.
Yes. And that expectation of the Fed cutting while the BOJ hikes, that's what's really putting the brakes on USD/JPY moving much higher.
Makes sense. And rounding out the G3 central banks, what about the ECB? Any fresh signals impacting the euro? EURUSD is around, what, 1.1750?
Yeah, about 1.1752. The signal from the ECB was more about stability. We had board member Kazakhs basically say the current 2% policy rate is fine, they can hold it there unless there are major new economic shocks.
So after a busy year of cuts, they're signaling a pause.
Pretty much. Stability from the ECB. And compared to a Fed that's actively considering more cuts, that ECB stability actually provides some support for the euro side of that EUR-USD pair.
Okay, got it. Now let's tackle the elephant in the room. The U.S. government shutdown. It's dragging on. Day 2 now.
Yeah.
And for investors, the real issue isn't just the political noise, right? It's the data.
That's exactly it. The data drought. The shutdown started midnight ET, October 1st. Roughly 750,000 federal workers furloughed.
Yeah.
But the immediate hit for us, for the markets, key economic stats are delayed. No official BLS jobs report this week. No weekly jobless claims.
So the Fed is flying blind.
Essentially, yes. They have to rely much more heavily on unofficial stuff, like that ADP report we just talked about. It increases uncertainty significantly.
And the sources suggest this isn't just, passive gridlock. There's some active political maneuvering going on using the shutdown.
Oh, definitely. The sources point out the administration is freezing about $18 billion in federal funds. Infrastructure money.
For specific states.
Yeah, specifically targeting states run by political opponents, like New York. It's a clear tactic. Using the shutdown as leverage deepens the political risk perception.
Okay, so we've got this mix. Weak data pushing the Fed towards cuts, but also a shutdown creating this huge data blind spot and political uncertainty. How are investors reacting? Is sentiment finally cracking? Panic.
You'd think so, right? But surprisingly, no. The market seems to be, well, shrugging it off.
Really? How can we tell?
Look at volatility. The VIX index, it's super low, trading around 16.
Wow, 16. That's calm.
Very calm. And other sentiment gauges, like the CNN Fear and Greed Index, the components like market volatility, stock price breadth, they're just not flashing panic signals despite the headlines.
But is it calm or is it complacency? Are investors just ignoring the political risk because the AI story feels so strong? Or maybe because the shutdown is actually hiding bad data that might normally spook them?
That's the tension, isn't it? Right now, it feels like the AI momentum is just giving everyone justification to treat the shutdown as, temporary political theater.
Focus on what you know, ignore what you don't.
Kind of. They're focusing on the weak data we did get, the ADP report, because it supports Fed cuts, which is bullish, classically. And they're ignoring the uncertainty from the data we can't see because of the shutdown.
Interesting dynamic. Okay, let's shift gears slightly. Let's look at some specific company stories. Because even in this kind of euphoric market, individual company risk is definitely still a thing. What's the story with Nidec?
Right, Nidec, major Japanese motor manufacturer, they're in a bit of a corporate crisis, actually.
Oh.
Their auditor, the firm checking their books, issued what's called an opinion not expressed on their latest securities report.
That sounds bad. What does it mean?
It's really bad. It means the auditor essentially couldn't get comfortable enough with the numbers, likely due to accounting irregularities they found, to actually give an opinion on whether the financial statements are fair. They couldn't vouch for them.
Yikes.
Yeah.
That kills credit trust, I imagine.
Absolutely destroys it. The market reaction was immediate. The spread on Nidec bonds due November 2025, basically the extra yield investors demand to hold their debt compared to safe government bonds, it blew out to a record high, around 36 basis points.
And the stock?
Down 17%. It's a really stark reminder that, governance issues, accounting problems, they can vaporize value instantly, no matter the broader market mood.
Definitely a cautionary tale. And Sony Financial Group.
Yeah.
Big name, obviously. But their recent listing didn't go so well.
No, it was quite poor, actually. Sony Financial Group, SFG, it was a direct listing, and the stock fell 16% in just the first 3 days, trading below its indicative price.
Why such a weak start?
A couple of main reasons cited in the sources. First, its dividend yield was apparently lower than its peers in the insurance sector, making it less attractive relatively.
Okay.
But second, and this is more of a technical structural thing, there was apparently massive selling pressure. Estimated around 125 million shares.
Who was selling?
Passive funds, it seems. Apparently, the stock was briefly included in the Nikkei average index around the listing, then quickly excluded. So all the index funds that had bought it then had to immediately turn around and sell it.
Ah, forced selling.
Exactly. That huge wave of forced selling just overwhelmed any natural buying demand right at the start. Structural plumbing issue, really.
Fascinating. Okay, one more specific point related to capital flows. A comment about the private equity world, tying back to AI.
Yeah, this was interesting. A point made by KKR, the big PE firm, they noted there are something like 19,000 private equity funds just in the U.S.
19,000.
Get this, that's more than the number of McDonald's restaurants in the country, which is around 14,000. KKR called the situation crazy.
Wow, that paints a picture of intense competition.
For sure, intense competition for deals, which probably puts pressure on future returns. But the irony, tying it back to AI, is that this incredibly crowded field is now chasing colossal amounts of AI-related investment. Another firm, Brookfield, estimated something like $7 trillion in global investment is needed just for AI infrastructure growth.
7 trillion.
So the money is definitely flowing into that AI theme massively, but the competition among all those funds to actually deploy that capital wisely must be absolutely ferocious.
That KKR stat really puts the scale of PE into perspective. Okay, let's wrap up by looking ahead. What's left on the economic calendar for today, October 2nd, based on investing.com?
Okay, so for the U.S., we still have durables excluding defense and factory orders data coming up at 10:00 a.m. Eastern Time.
Got it. Any Fed speakers?
Yes, later today we're scheduled to hear from Fed officials Logan and Goolsbee. Always worth watching their comments.
And for the BOJ watchers?
BOJ Governor Ueda is set to speak tonight. That's 9:05 p.m. Eastern Time, so potentially market moving for the yen overnight.
Okay, great rundown. So what does this all mean? Let's try and synthesize.
Well, I think we're clearly in a market with two competing narratives right now. But the dominant one, for the moment, is the AI momentum. It seems powerful enough to let investors look past, or maybe just ignore, major macro risks like the U.S. shutdown and the data uncertainty it creates.
Right. The AI story provides the cover.
Exactly. And the weaker U.S. dollar, which we see in your USD moving up and USD JPY being capped, that's really a direct consequence of the market strongly believing the Fed will cut rates based on that weaker labor data we got.
Okay.
But while the broad market feels strong, those specific stories like NYDEX counting issues or Sony FG's listing problems, they're important reminders. Idiosyncratic risk is still very real. You still need to do your homework on individual names and be aware of those market plumbing issues.
Absolutely. So that leads us to maybe a final thought for everyone listening to chew on. This whole AI rally, it's being spearheaded by these incredible private valuations, right? OpenAI at $500 billion, and this belief that trillions in capital investment will follow.
How durable is that momentum if the actual profits of the public companies involved start to lag the hype? Or what if those massive $7 trillion capital flows hit unexpected roadblocks or delays? How vulnerable is the narrative then? Something to definitely keep an eye on going forward. Thanks for diving deep with us. Don't forget to like and subscribe.